As the year comes to a close, insurance companies are scrambling to redesign their products to comply with Regulation 7702. Here to shed a bit of light on the subject is Sam Roque, Senior Vice President of Protection for Ash Brokerage. Mr. Roque, we're hearing a lot about Regulation 7702. What can you tell us about it?
IRS Code Section 7702 is the section in the tax code that governs and defines what is a life insurance policy. And it also defines what is a modified endowment contract and what is not. When this was all sort of initially codified, if you will, in the 80s, this was built in with sort of hard-coded interest rates, and the hard-coded interest rate back then was 4% for a lot of the calculations. And there's a lot of minutia as to how you calculate what's a life insurance policy, how you calculate what is a modified endowment contract, but it all ties back to an interest rate and a life expectancy. And because it's connected to those two things, the interest rate has a significant impact on the outcome. It was hard coded at 4% in an era where rates were 8, 10, 12%. And it wasn't really contemplated that we could be in a prolonged low interest rate environment. Fast forward to 2020, we're in a period of time where the 10-year treasury had dipped below 1%, and briefly even the 30-year treasury had dipped below 1%. And legislators and insurance companies realized that that 4% interest rate was outdated. And because they'd realized it was outdated, that was causing problems for a number of insurance companies, particularly whole life companies. If you paid close enough attention, you'd realize that some insurance companies were having a hard time pricing like a 10-pay whole life product. And it was almost entirely because of the nuance to 7702 that I've been discussing. And so you saw Mass Mutual come out with a 12-pay product because they were having a hard time pricing their 10-pay product without triggering modified endowment contract status. So at the end of 2020, very, very quietly, insurance companies got legislators to very briefly and discreetly open up 7702. Now, nobody in the industry wants legislators to look particularly carefully at 7702 because no one wants to adjust the tax benefits of life insurance, right? We enjoy tax deferred growth. We enjoy withdrawal of cost basis on a tax-free basis, as well as borrowing against gains and a tax-free death benefit. So nobody really wants to adjust that, but legislators and insurance companies realized that we had a problem. And so what they did was they went in and they changed that interest rate. And really that was pretty much all that they changed. And they essentially make the rate float now, but they tie it to a more relevant interest rate benchmark. That's a really long-winded explanation of basically saying that now, after the changes to 7702, which pretty much every insurance company, save for a few, have adjusted their products to fit within this new construct. The long and short of it is you can now put in more premium into a life insurance policy without triggering modified endowment contract status or jeopardizing the definition of life insurance test, neither of which are things that you want to mess with typically. Off the cuff, that sounds kind of bad, right? More premium into your policy. For a lot of reasons, that's actually a good thing if you want to accumulate a lot of cash value in your policy and take advantage of the tax deferral and tax-free nature on the back end of the policy proceeds. So functionally what you get is more efficient cash accumulation vehicles. That's the net result of the changes to 7702. And it comes at a really interesting time where legislators are strongly contemplating increasing marginal tax rates, increasing tax rates on long-term capital gains and qualified dividends, adding a surtax to those in the highest income tax bracket. So it comes at a really interesting point in time and a really relevant point in time. So the intersection between tax changes and the changes to 7702 has been a really interesting time, and we've therefore seen a really significant uptick in that type of business.
What changes do you see in the life insurance industry as we enter 2022?
Well, so a lot of the changes have happened already. So pretty much every insurance company has adjusted their internal tests inside policies that define what is a MEC and what is a life insurance policy. So those things have already sort of been baked in. Contracts have already gotten more sort of cost efficient, so to speak. And so the first of the year won't necessarily mean any dramatic difference other than this. And this will be a little bit of a challenge kind of moving year to year, is because the interest rate floats, the test will in theory be calculated slightly differently next year. And so, that minimum non-MEC death benefit, if it was $1 million in 2020, might be $1,050,000 in 2021. Now, one important sort of nuance to understand here is that once you put a contract in place, the 7702 calculations are good throughout the life of the contract. It does not change that contract. You're essentially locking it in. So the change that would happen between 2020 and 2021 would really only be relevant for contracts that are issued in 2021. So I don't anticipate any significant differences. Rates haven't really changed that much in the last year. That could change between now and the end of the year. And there's a lot of interesting things going on in our economic environment. But that could change year to year. But you also should know that once you lock it in the contract, it is locked in through the life of the policy.
That is very good information. Is there anything you'd like to add?
The only thing I would add is that it's just a really interesting time to be considering this. We're going to find out here in the next few days, at the next few weeks, whether or not there's a new bill with increased taxes in it. And ultimately, that'll be relevant for a long period of time. But ultimately, the will of the people seems to be increased taxes among the wealthy. And you kind of have to look at where we've been, as well as sort of where we're going in terms of where tax rates might be, not just for the next year, but for the next 5, 10, 15 years. And so we're going to see a really significant uptick in the value of financial advice and the value of financial planning. Advisors that do planning from a tax perspective are going to be really well positioned for the future. The value of financial advice is going to be significant. Very few of these changes are what you would call simple. And so the forecast for complexity is high, and individuals, families, businesses, they need good guidance as to how they plan for the future.
Thanks for sharing your knowledge with us, Mr. Roque. That's not only great information, but a good reason for advisors to be members of NAIFA.